Welcome to Talk Tickers, your shortcut to understanding the critical insights from today's earnings calls. We're diving straight into the Rexford Industrial first quarter 2025 results. What do we need to know?
Well, Rexford put up a solid first quarter, pretty much right in line with what folks were expecting. Their core FFO, that's, funds from operations, a key metric here, it hits 62 cents per share.
Okay, 62 cents. And how does that compare?
That's actually up 7%, both from last quarter and from Q1 last year. So decent growth there.
Got it. And the outlook for the full year, any changes?
Nope, they're holding steady on that, still guiding for $2.37 to $2.41 per share for the full year 2025.
Okay. And what about the actual leasing? How are rents holding up?
Leasing spreads are still looking pretty strong. Net effective spreads were around 25%.
25%, okay. And cash spreads?
Cash spreads were closer to 15%, and tenant retention was really good too, 82%.
82%, that sounds high.
Yeah, it's their best in the past year, so tenants seem to be sticking around.
All right, so solid headline numbers. Let's unpack what's underneath that a bit more. What drove the leasing activity?
So they signed leases for about 2.4 million square feet in the quarter. And what's interesting is that 400,000 square feet of that came from just 5 of their repositioning and redevelopment projects.
So those value-add projects are starting to contribute lease-up.
Exactly. Seems like those investments are beginning to pay off. And overall absorption in their portfolio was positive, about 125,000 square feet.
Okay, but I thought I saw something about market rents dipping. How does that square with the strong leasing spreads?
Yeah, that's a really important point. So within Rexford's own portfolio, the estimated market rents did decline sequentially by about 2.8%.
Okay.
And year over year, that decline was 9.4%.
Right. That sounds less good.
Well, yes and no. The key thing here is that this decline was actually less severe than the drop seen in the broader Southern California market. So relatively speaking, they outperformed.
Okay. So context matters. Was this rent decline broad-based across their portfolio?
Not really. Management specifically called out that the softness was mainly concentrated in their larger spaces, think over 100,000 square feet.
Right.
And it was in specific submarkets, Midcounties North, Orange County, and the Inland Empire West.
So bigger boxes in certain areas felt the pressure. What about smaller spaces?
That's the flip side. They said smaller format spaces, so under 50,000 square feet, showed a lot more resilience. It's almost like two different stories depending on size.
Interesting. Did they mention anything about the pace of leasing? Any changes there?
They did. They said activity had picked up nicely at the start of the year, but, recently, especially after those tariff announcements, they've seen some tenants kind of deferring decisions.
Tariff uncertainty creeping in. How's that impacting their vacant space?
Well, they currently have active leasing discussions on about 80% of their vacant space. That's down a bit from 90% earlier.
Okay, so maybe a slight slowdown in decision-making.
Yeah, and management basically flagged that they might see lease-up times extend a little because of this uncertainty. Could take a bit longer to fill those empty spots.
Makes sense. Okay, let's switch gears to capital allocation. What's the strategy there?
It's pretty focused. They're trying to stabilize their improved assets, those repositioning projects, at yields above the market average. And then on the other side, sell off certain properties at really low cap rates, often to owner users, to basically recycle that capital and drive cash flow growth.
Okay, stabilize high, sell low. Did they do much of that in Q1?
They did. They stabilized 5 of those repositioning projects. That's about 560,000 square feet at a 7.6% unleveraged yield, which is quite attractive.
7.6%, yeah, that's solid. And dispositions.
Sold 2 properties for $13 million. And the interesting part, they got low 4% exit cap rates on those.
Low 4s. Wow. Who's buying at those rates?
Get this. They were unsolicited offers from owner users, people who actually want to occupy the space themselves.
Interesting. So strong demand from users willing to pay up for location. Anything else in the disposition pipeline?
Yeah, they have about another $30 million under contract or with accepted offers, but notably no new acquisitions currently under contract. The focus is really internal right now.
Right, focusing on their existing assets and developments.
Yeah.
How much income do they expect from those projects soon?
They're projecting about $70 million of incremental NOI net operating income from the 3.2 million square feet of repositioning and redevelopment they have either under construction or in lease-up right now. So quite a bit of built-in growth.
Okay, 70 million. Let's talk about the financials then and the guidance. The core FFO included some one-off items.
Yeah, 62 cents included about 4 cents per share from expected lease termination fees. These were from known tenant move-outs, so not a huge surprise.
Right, and you mentioned they expect lease-up to take longer now, 9 months instead of 8. But they kept the guidance the same. How they managed that?
Good question. They said they're offsetting that slightly longer expected downtime by using short-term lease extensions on some properties that are slated for future redevelopment anyway.
Ah, clever. So they keep some income flowing while they wait to start the next project.
Exactly. It helps bridge the gap. And because of that, their projection for the net NOI contribution from these value-add projects in 2025 is still holding at $15 million.
Got it. And what about lease expirations for the rest of the year? Any big cliffs coming up?
Seems manageable. Only about 11% of their total rent roll, the ADR, is set to expire through the end of this year. And most of that is weighted towards the second half, Q3 and Q4.
Okay, so pretty good visibility on near-term income. Let's look at the balance sheet. How are they positioned financially?
Very strong, actually. They highlighted having over $1.6 billion in liquidity.
Wow, $1.6 billion. How does that break down?
Well, it includes about $68 million in cash, but the big piece is they have almost full availability on their $1 billion unsecured credit line.
Okay, plenty of dry powder. And debt levels.
They actually brought their leverage down. Net debt to EBITDA is now at 3.9 times. That reduction was helped by the settlement of some forward equity they held.
3.9 times. That's quite low for a REIT. Are they doing anything else with their debt?
They're in the process of recasting their main credit facility. The goal is basically to extend the duration, lock in potentially lower interest costs, boost liquidity even further, and just generally get more flexibility.
Makes sense in the current environment. When does that close?
They expect it to close this month in May. It also involves refinancing a $400 million term loan. So the upshot is they won't have any significant debt maturities until 2027.
Pushing out maturities, lowering leverage. Sounds like prudent balance sheet management.
Definitely seems that way.
Okay, let's shift to the market itself. What are they saying about their specific niche in Southern California?
They really emphasize the long-term supply-demand imbalance in their core market, infill Southern California, just not enough space for the demand.
Right, the scarcity factor.
Exactly. And they argued that tenant demand there is mainly driven by regional consumption, people buying stuff locally, which in their view makes their portfolio relatively more insulated from swings in global trade flows compared to, say, massive distribution centers tied purely to imports.
Okay, so less dependent on containers coming from overseas, more on serving the local population. What kind of tenants are driving that demand?
It's pretty diverse, actually. They mentioned manufacturing, construction, defense, and aerospace companies, and then warehousing and distribution, but specifically for consumer staples, things people buy regularly.
A broad base.
Yeah.
And they mentioned embedded growth earlier.
Yeah, they put a number on it. $230 million, a projected incremental NOI just embedded within their existing portfolio through mark-to-market on leases and completing current projects.
$230 million. That's a lot of potential organic growth baked in.
It really is. Now, they did acknowledge the tariff situation again.
Right, the uncertainty.
Yeah, causing some tenants to pause or defer decisions. But management seemed pretty confident, arguing their infill tenant base has historically been resilient during downturns.
Why is that, in their view?
Scarce space is one thing, but also the need for these businesses to be close to distribution points, close to skilled labor, and plugged into the existing business ecosystem there. They feel those factors keep tenants anchored.
Okay. Did they talk about how they stress tested their guidance against potential downturns?
They did. They looked back at things like the pandemic, the GFC, even recent rent changes in SoCal. They modeled scenarios focusing on longer lease-up times, potential market rent drops, higher bad debt, and lower occupancy.
And the bottom end of their guidance reflects that.
Pretty much. That $2.37 lower end factors in things like a 9-month lease-up average, elevated bad debt, say 75 basis points, which is higher than usual for them, and potential market rent pressures. So they've built in some cushion.
Got it. There was one slightly odd number, a negative cash leasing spread of 5% this quarter. What was that about?
Yeah, they addressed that. Said it was basically due to one specific lease renewal. The prior rent on that space was way above market because of some specialized improvements the old tenant had paid for.
So a one-off situation with a weird comp.
Exactly. And in the small sample size for that type of lease, it skewed the average negative. They suggested it wasn't indicative of a broader trend.
Okay, that makes more sense. What about the NOI from developments this year? Can you break that down?
Sure. They expect about $30 million in total incremental NOI from development completions in 2025.
Right.
About $9 million of that hit in Q1.
Right.
with the rest, so $21 million, expected more towards the back half of the year.
Okay. And is any NOI coming offline for redevelopment?
Yes, about $15 million is expected to come offline as they take spaces back for redevelopment. That's expected to happen pretty ratably throughout the year.
Got it. And those lease termination fees in Q1, anything unusual there besides the known move-outs?
Well, part of that termination revenue actually came from an old office property they bought specifically to tear down and redevelop as industrial later.
Okay. And bad debt. They expect that 75 basis points for the full year.
Yeah, Q1 performance was actually really strong on bad debt, very low. But they expect it to normalize closer to that 75 basis point level for the rest of the year.
All right. One last detail, rent escalators. Are they still getting those 4% plus bumps in leases?
Seeing a little pressure there. The average escalator signed in Q1 was 3.6%, down slightly from around 4% last year.
Is that across the board?
Again, it seems size dependent. The pressure was concentrated in the larger spaces, over 100K square feet, where they average about 3.4%. Smaller spaces were still getting closer to that 4% mark.
So the theme continues. Smaller infill spaces showing more resilience.
That seems to be the core message. Scarcity, consumption-driven demand, and infill SoCal provide stability, and their redevelopment strategy is key for growth, citing that, 20% incremental return on the project stabilized in Q1.
Right. What about occupancy? Where did that land and where's it headed?
Same-store occupancy ended Q1 at 95.7%. They expect it to stay around that level by year-end, though it might dip a mid-year Q2, Q3, before bouncing back in Q4.
And total portfolio occupancy, that's lower, right, because of the redevelopment.
Exactly. Total portfolio is sitting more in the 90-91% range because of the space intentionally held vacant for repositioning or redevelopment.
Okay. And with all that cash they have, why not more acquisitions? You said they have like $600 million plus the credit line.
Their point was that reinvesting in these high-return repositioning and redevelopment projects within their existing footprint is currently the best, most accretive use of capital. Better returns than buying new assets right now, in their view.
Gotcha. Last thing on tenants, any concerns about 3PLs, third-party logistics providers?
They said their exposure is limited. They're apparently quite selective on credit, even turned down a lot of potential tenants. And the Asian 3PLs they do have are well established with solid credit profiles, according to management.
Okay, so for investors listening, where are the key takeaways here? Maintaining guidance seems like a big one, despite the tariff noise.
Absolutely. It signals management's confidence, right? Confidence in their specific market, the infill SoCal niche, and the embedded growth they keep talking about.
And that focus on infill, especially the strength in smaller spaces, might suggest it's a more stable part of the industrial sector compared to maybe the giant distribution hubs.
Could be, yeah. It highlights a potential divergence based on location and function. Plus, their balance sheet moves, paying down debt, recasting the credit line that gives them a lot of financial flexibility, whatever happens in the broader economy.
And that $230 million in embedded NOI, plus the $70 million from near-term projects, that's a significant amount of growth already kind of baked into the system, separate from any new deals.
It is. It provides a clear path to future earnings growth, assuming they execute on those plans.
All right. Now for our segment we like to call This Is Not Financial Advice. Time for some outrageous but plausible trade ideas based on what we just heard. You go first.
Okay, here's one. Given Rexford's laser focus on infill Southern California and the resilience they're highlighting, especially in smaller spaces, maybe you consider a pair trade. Go long, Rexford, REXR. But pair it with a short position in, say, a broader industrial REIT index, or maybe a specific REIT that has heavy exposure to those massive distribution centers located outside the prime consumption hubs.
Okay, so betting on the regional consumption-driven story to outperform the global trade, big box logistics story, especially if tariffs bite.
That's the thesis, yeah. That Rexford's niche proves more defensive or even benefits relative to assets more tied to potentially disrupted global supply chains. Again, totally hypothetical, not advice.
Outrageous but plausible.
Yeah.
I like it. Okay, my turn. Rexford mentioned selling properties at really low cap rates to owner users, right?
Yeah, unsolicited offers in the low 4% range.
So idea 2, maybe try to identify companies in Southern California in industries that use the kind of space Rexford owns that might be logical candidates to buy their own buildings instead of leasing.
Trying to front-run the next owner-user purchase.
Kind of. If you could identify a few well-capitalized private or even public companies in manufacturing, aerospace, or distribution in that area, who might want to lock down their real estate footprint, Maybe a long position in a select few of those companies could pay off if they follow that trend and decide owning is better than renting long term.
Interesting angle. Leverages that trend Rexford is benefiting from on the sales side. Again, purely speculative.
Definitely not financial advice, just thinking out loud.
All right. So, summing up Rexford's Q1.
Yeah, I mean, it looks like a solid quarter overall. They demonstrated resilience. They've got that embedded growth pipeline, and they seem to be managing the balance sheet proactively.
Agreed. Navigating the current uncertainties, like the tariff talk, with a pretty clear strategy focused on their specific market and internal value creation.
As always, remember everyone, what we discussed today is just our take based on the earnings call. It's absolutely crucial you do your own homework and thorough research before making any investment decisions. Maybe a final thought to leave folks with. How durable is this perceived resilience of infill industrial real estate, especially in high-cost markets like Southern California, if we see a broader economic slowdown? Something to chew on. We encourage you to dig deeper into Rexford and these market trends.